Hello traders, Corey Mitchell here. In this video I want to do what I call a technical indicator deep dive. We're going to be looking at the MACD today. This is probably one of the most popular indicators out there. I see a fair bit of misinformation on it, people discussing the indicator without really understanding how it moves or how it's created. So my goal here is not to really provide so much strategies. We might touch on how the indicator is used a little bit. But my goal is really just to help you understand how the MACD is constructed, how it moves relative to price action, so that when you are using this in the strategy or you read about a MACD strategy, you can tell if maybe it's a little random or the person doesn't really know what they're talking about, because you'll have a deep understanding of how this indicator is created. So it's probably one of the most simple formulas out there for an indicator, and it is simply a 12-period moving average minus a 26-period moving average. I'll just delete a couple of these things for the moment. And what this ends up giving us is most of us are used to seeing a MACD like this, or maybe the histogram's missing, something like that. But this is really what the MACD is just this one single line which is produced by this formula, a 12-period moving average minus a 26-period moving average. Now, if we put a 12-period moving average and a 26-period moving average, the MACD is usually a exponential moving average. You can put it as a simple moving average if you want. I have it set, I have simple moving averages on the chart, and my MACD is based on simple moving averages just for comparison, but you could change these to EMAs and change this to EMA and you get the exact same outcome. So not the exact same outcome, but how the indicator is constructed would still be the same. The MACD is the dollar difference. So we're looking at a stock. This is dollar difference between these two lines. So if we look at where these cross over, when the 12-period moving average crosses above the 26-period moving average, that is a zero line crossover, because basically they're at exactly the same price, so that means there is zero difference between them. And when the MACD crosses, or when the 12 crosses below the 26, that's when you're going to get a zero line crossover from above. We're moving below the zero line. At that zero line, they're at the exact same spot. Then the 12-period moves ahead. We can see the price is dropping, so the 12-period moving average is tracking that price action quicker than the 26-period moving average. So we start to get separation between these two moving averages, and that's what this number is. Along the right axis of the MACD, that's what this number is. So let's just pick a random point that's easy to spot. So let's say this green bar right next to this red one. Let me just mark it on the chart so I don't lose it. Yeah, let's do this one here. Okay, so let's take that green bar. Now we can see below it there are two moving averages, and we can take their values, and you can see the values of the moving average up here. So we can see 88.60 minus 84.93 is equal to 367. And if we scroll down, we can see the MACD is at 366. So maybe there was a little bit of a rounding error there in one of the averages. But we can see that whatever the difference is between these averages, that's what the MACD value is going to be. So you could do that with any one of these and just take the difference on that line, 124.91 minus 121.59. Gives us 332, and if we just look down at the bottom here, hopefully I can find that again, we're at 332. So this line, or this MACD line, is simply telling us the data points are just all connected, so it's a continuous line, but at each price bar, the data point of that point is the difference between this moving average and this moving average. And that's all there is to this indicator. And as I said, zero line crossovers are when the averages are exactly the same price and they're making a crossover of each other. So each zero line crossover is when those 26 and 12 period moving averages are crossing. So let's get rid of that for right now. Now this indicator might look a little bit incomplete at the moment. So what's typically added to it is called a signal line. It's usually a 9 period moving average of the MACD. It has nothing to do with what's going on up here. There is not a single calculation in this signal line from up here. The MACD is taking the difference of these moving averages. This moving average is simply a 9 period moving average of each one of these values. Remember, as we talked about, each price bar is a value. As we tick along, we can see right now MACD is at 411, 409, and that's just the difference between these moving averages at each one of those data points. The last 9 data points are summed up, averaged, and that produces the signal line. So the signal line, if we thought of it as, if this is 9 periods right here, all those are added up to produce this data point right here, for example. And then the next, to create the next one, the last 9 data points from the MACD are added up, averaged, add them up, divide by 9 to create the average for a simple moving average. So that's what this line is. It's just going to trail behind the MACD. It has nothing to do with what's going on with the price action. But it can be used as, some strategies use it as a trade signal, or it can be used as to kind of an early alert that the price action may be changing. Because if we look at what's happening, we can see we're below the zero line here in this area. The 12 period has moved below. We are dropping. We're below the zero line. That means the 12 is below the 26 period moving average on our price chart. We've moved far apart. So that's why this blue line dropped so far. Let's just get rid of this for 1 second. So that's why it's dropped so far. But we can see it's starting to turn back up. When that happens, that means our 12 period moving average is starting to move back toward the 26 period moving average. So they're starting to move a little closer together. So when we add that signal line on, it can sometimes give us a little notification, I guess you could say, that that is starting to turn up. Those moving averages are starting to move closer together. That may or may not mean that the price is going to turn higher and continue higher. Sometimes it may continue a lot higher. Other times it may continue a little bit higher. We don't know. But it is telling us, those moving averages are getting closer. So when this crosses over, this is how some people use it, when the MACD crosses over this signal line, it's just an alert that, hey, yeah, we're starting to turn back up in the MACD. The price is starting to move up. This moving average is starting to move toward the other moving averages. They're converging. Maybe they'll cross and we'll get above that zero line again. So this is basically a little bit of a forewarning that this could happen, that the price can move, or that MACD could move back up toward that zero line. I like using other tools and price action, as I've said, to confirm anything the MACD is doing, because the MACD is simply based on price action. So typically what you're going to see in the MACD, you could also just see by looking at the charts, especially if you throw some moving averages on there. So that's how those two work and how they work together. I want to reiterate again, this line has nothing to do with what's going on with the price action. It does not indicate necessarily a reversal. These are all based on past data. Moving averages are historical indicators. They're all lagging indicators. They're based on what's happened in the past. Each value is based on prior values. Same with the MACD. The MACD is based on what's happening in these moving averages, which is a lagging indicator. and then this signal line is simply a lagging indicator of the MACD. So now let's add in the other missing piece and explain what that does. The histogram is the difference between the MACD line and the signal line. So when they get farther apart, you're going to see a bigger histogram. Basically, the difference between these two values gets bigger, and this histogram is just measuring the difference. When they're very close together, you have tiny histogram values, just because if you took the difference between this, the signal line and the MACD here, it's only a very small amount. When you take it over here, there's a bigger gap or a bigger difference between the MACD and the signal line, so you have a higher value. Once those start to close in on each other, then you have them, the histogram is going to start moving back toward 0. So again, it's just the closeness, and then when you get a crossover, it moves back to 0. So right here, we can see the MACD crosses below the signal line, and for a brief second there, it's really close to 0. And then as the MACD starts to pull away from the signal line, then the histogram shows how much separation there is. So that's what the histogram does. So the histogram, again, has nothing to do necessarily with what's going on up here. It's measuring the difference between the MACD and the signal line, and the only thing that's measuring the price action is the MACD, and it's doing it sort of through two other indicators, which are the moving averages. So that's how the indicator is constructed. Something else that traders will look at is divergence. I have a bit of a problem with divergence because it's going to probably work about as often as it does. As often as it doesn't. So there's a few things you really got to be aware of with the MACD and how it moves in order to understand when divergence is, let's call it, legitimate, and when it's possibly giving a false signal or the price action isn't really confirming the divergence on the MACD. So here was a really good example where Apple starts off with it's pretty strong downtrend, and then we start to accelerate to the upside. And these signal lines aren't really going to matter for what I'm going to talk about, so I'm just going to get rid of them so that we can just really focus on the MACD. This is the MACD indicator. Everything else is just kind of things to help measure the MACD. Here, so really strong move up, where we have a strong separation here, and then it starts to narrow, so we get the crossover. So we basically have the price recovering, the moving average, the 12-period moving average recovering, erasing the gap between these two, and then it starts to move above, so then we get the separation on the upside. So really big move up here. And then it looks like it almost flatlines. Here we have a much higher swing high in the stock, yet the MACD is moving lower. So by looking at divergence, this could look like a bad thing, especially when it continues for so long. The price is trying to keep moving up, but we still haven't even moved above this high. But we have to look at, this was a pretty big price move, and anytime that happens, we're going to get this big move from the separation that occurred here, and then we're adding to it the separation that occurs here, because this one occurred below and this one occurred above, so it results in a big move up. Now, just because this happens doesn't mean that the price is going to reverse. We can see this MACD really flatlined. It was not in a bullish state at all, yet the price kept rising and rising and rising. Now, how does that happen? Well, it happened because the distance between the moving average didn't really change, yet there was no indication from the price action that this stock was in any trouble or going to drop, anything like that. In fact, the price barely dropped below the 12-period moving average this entire time. This is a really strong stock. The MACD is just measuring the difference between these two moving averages, so it flattened out basically as soon as this trend just kept kind of going at the same angle, which means those moving averages are going to stay at the same angle the whole time. That's not a problem. It's something to be aware of. So this is why this happened in the MACD. It was a divergence, but the price action wasn't giving signs that it was a problem. Over here, we do have a divergence, which was a little bit more, I guess you could say, a bit of a warning sign. One thing I'll point out, this is not divergence over here. We have a big move up here, followed by a smaller rally. This is exactly what the price did. It made a big move up, dropped, MACD dropped, rallied back up, and they both made a lower swing high. So this is just normal. This is what we would expect to see. So nothing wrong with what's going on there. So that's basically confirming each other there. Over here, we have this longer move up again, followed by a brief pullback, followed by a pretty sharp little rise here, but we have a lower swing low on the MACD. Now, if we look at where these started, or how long they took, we can see this rally from here to here. Or we could draw it in here. It's taken about a couple weeks, maybe a little more than a couple weeks. And, we've moved up about 15% or so. And that couple weeks gives these moving averages some time to separate. So this allows the MACD to move up because there is some separation, more separation created as this goes up. They get pretty close together here. Again, another little squeeze where they get close and they stay together for a while. And then we get a bit of an escalation to the upside in the price. So these moving averages diverge and create a higher value in the MACD because we're taking the difference between this one and this one. Now we get over here, they drop right back to pretty much zero, and then it's going to take some time for those moving averages to separate again. But very quickly, before it even has a chance to really separate, the price is already dropping back to the downside. So it's interesting that this peak actually occurred after the high. And that happens because, remember, moving averages are always measuring the past. These are taking this is averaging out the last 12. So it's looking at this big spike and it's still including it. And it only starts to turn down once these, big spiky moves are eliminated from the last 12 values that it's calculating. Then it starts to roll over. So this divergence was interesting to me because by this point, once we start to see it, yeah, we've had a new swing high here. This high compared to this high. Nice swing high, but this MACD it didn't have enough time to really get any separation there. And this high point occurs after the high, and we're starting to rotate lower. So this in itself might not be a signal for me to worry. Again, I don't really use indicators much, but if I was using them, this would maybe just say, hey, let's check out the price action here. Is there anything going on? And we made a new swing high, so that's good. But once the price starts rolling over into this area, especially once it undercuts this swing low, I'd be a little bit starting to get leery and maybe consider selling that position because we do see that we just don't have the same momentum that we did before. And the momentum we do have was very short-lived before a swift decline. We can also look at the overall. This is a very long uptrend that created this very high value. And at no point through this rally's been much more choppy. Notice how we had the constant separation here, which, on the MACD actually doesn't look so good. But from a price action perspective, when we're combining it with the MACD, we can see like lots of separation throughout this uptrend, very strong uptrend. And through here, not a lot of separation, lots of choppiness, lots of zero line crossovers. So this price action in here, which the MACD also helps us confirm, much more choppier. We never quite got the separation again that we had before. All little bits of separation, just not enough momentum to really cause this price to spike up, or the moving averages to then separate because of the price action being stronger. So the MACD didn't cause anything in the price action. It's just interpreting and measuring what the price action is doing. And the price action through this area, much more choppy. So then we could also look back at this much bigger divergence and say, yeah, there's definitely something different going on. This is very strong. This seems a little bit weaker. It doesn't mean it is going to roll over. It just means be aware that the MACD is telling us choppier price action. Our moving averages, which the MACD is just interpreting, or measuring, is saying choppier trading, and the price action itself is even saying choppier trading here. So that's how you can use the MACD, how it's constructed. Let's throw all these other ones on here just so it looks more familiar to you. And that's how it's constructed, and that's how you can use price action as well as the MACD to help verify. There are, like I mentioned, there are some shortcomings in the MACD in terms of you'll sometimes get divergence when the price is still really strong, and other times you'll get divergence and it is actually legitimate because the price action is telling you the same thing. So if you're going to use indicators, they can help you maybe spot things that, if you're not used to trading on price action, then they just make you look at certain things maybe a little bit closer, so it can be useful for that. They can also be used for some trade signals when there's crossovers or zero line crossovers, but I'll leave that up to you to discover. And this was more just to help you feel really comfortable with how the MACD works and how it relates to the price action and the moving averages that it's measuring. So until next time, we'll be doing more of these technical indicator deep dives on other indicators, so stay tuned for those. And until then, happy trading.